Welcome everybody to the 4-Star Podcast. This is our inaugural podcast for the year of 2022. So welcome. We're going to do a little recap of the year before. A very strange year, up year, but very strange year in this world, and have a full discussion about the markets and then what we see out there. I'm Brian Kasal. I'm the founder and CEO of 4-Star Wealth, and with me, of course, is Mr. Christopher Reardon.
Good afternoon, everyone out there. Glad to be on the podcast.
All right, welcome, Chris, again. And for those who are new, Chris is our 4-Star Director of Development. He runs all the portfolios and the trading and reports and marketing and all the other major important areas of the firm. He's a Clevelander. He loves his Cleveland Indians, comes from Cleveland, and he has a golden doodle puppy, Hudson, but he has a new addition to the family this year. So we begin the new year with a new member of the Reardon family. So, so congratulations to you, Chris, and your wife last year. Welcome to the podcast here, brother.
Yeah, thank you very much for having me on, and excited as we enter 2022.
All right, and again, I'm the founder and CEO of 4-Star Wealth. I'm an Eagle Scout, a National Boy Scout Foundation trustee, philanthropic advisor, chief dad to Quinn and Evan, and husband to the amazing Tripty. So we are going to do our full podcast today. And don't forget, if you like what you're hearing, please tell your friends to listen to what we're doing and give us a 5 out of 5 ranking on Apple iTunes. So Chris, before we get into the markets now, let's talk about last year. So last year was an up year, but it was a very strange up year in that most investors didn't do as well as the indexes because the indexes got so distorted, didn't they?
Yeah, I mean, you had a lot of distortions, not only from the economic side, but also the markets. A lot of it was supply chain issues. You had this continued ripple effect from COVID, and towards the later end of the year, you had the inflation. So there was a lot of volatility. I mean, some of that, once again, volatility was to the upside, and we definitely had, a case of, kind of winners and losers, if you will, driven by specific large cap stocks or mega cap stocks, I would say.
Yes. Well, and so just the actual numbers, the Dow Jones Industrials, which used to be a dividend stock index and is now trending more toward growth oriented, that was up 18.92. So that was a good year, better than average year. The NASDAQ, NASDAQ Composite, which is primarily a technology index, that was up 17. So not as much as the Dow, 17.16. The S&P 500, though, Chris, was up 27.23%. And most investors didn't do anywhere near that. And part of the reason is that the market got more and more narrow throughout the year. And now in the S&P 500, there are 11 major sectors. And one sector that did really well was the materials and commodity sectors. But then technology didn't do as well, but there were certain large names in the index that did so well, the massive names, that it really was a market of like 10 or 15 stocks that did really, really well. And unless you had those in very, very large proportions, you didn't do as well as the S&P index. 51% of the S&P index is now in technology and technology related sectors. So people don't buy stocks like that. They don't buy 50% in one sector and then the rest in all the rest of the market. So the estimates now from most of the mutual fund families that are coming out with reviews on how investors performed, not necessarily funds, is that over 90% of investors did not beat the S&P if they were trying to beat the S&P. Isn't that an interesting statistic?
No, it's fascinating. And you could even go a little further saying that, 5 stocks actually accounted for about a third of the S&P 500's movement. So at Microsoft, NVIDIA, Google, Tesla, and Apple, which everyone kind of, knows, mostly the FANG stocks, you would say,
Right.
With a little bit of additions there. But, they were the biggest drivers, and accounting for a third of an index as large as the S&P 500 really shows the impact that they have. And like you said, Brian, I mean, most people aren't going to comprise their portfolio of, a third of it being within these stocks. So it's really hard to outperform when you have so much movement on such few little stocks impacting the indexes.
Well, and then the average stock in the index was up about half what the average as calculated was. So if the average investor did 10 or 15% or even a high single digit number, that isn't actually far off what the average stock did. But a lot of people are going to say, gee, we're not happy with that. So the only people that performed in line with the index are the ones that had the index. They were indexed, right? And so in a year like the previous year, 2020, the indexes are down 35 and 40% at the worst point during the year. So indexing isn't always the best way to go, especially when markets are correcting and if we have a market crash. So we try to have some protection on the downside. But this year the index was the place to be. It was very hard to beat the index. And the very few people that beat the S&P 500 index were heavily concentrated in those names, Chris, that you mentioned.
Yep. Yeah, and I think it's a good point that like you said, if we have these 5 names, and you could even add a little bit more to it, names wise, but those had such a long run up during 2021, were main drivers behind the index's movement, that they now comprise, like you were saying in the beginning, Brian, a large portion of it. So if we do see those start to pull back, maybe they got bid up too much during the year, who knows, we could see the indexes start to trail. So it was a weird year in that, if you did index, you actually things turned out pretty well. But because the S&P tends to be a little bit more momentum based, and by that means, since these stocks are running, now they're comprising more and more of the overall index and having more and more of an impact on it. If they start to pull back, it's going to have more of a significant impact on the index's returns. So with that, maybe we may see some increased volatility now coming into 2022 because of such a large run up.
We could, for sure. And I mentioned this in a previous podcast, but let me cover this again. So this market is surprisingly similar to the market as it stood at the end of 1999. The old timers might remember the technology boom in the late 90s, and then the technology crash that happened in 2000 to 2002. And the S&P index declined 56% once they hit the highs from the next 2.5 years, bottoming in July of 2002. Technology stocks were down 70 to 90% after outperforming everything for 4 or 5 years, and depending on which index you were tracking. And now, with technology being such a very large part of the S&P 500, there's obviously the possibility that something like that could happen again. Now, once you say that, then many people will say, well, this time is different, and here is why. So I've already heard the explanations why this time is different. And yes, there are some differences between now and 1999, where technology has really created many, many more efficiencies in the economy than we really didn't have. We didn't even have Apple iPhones back in 1999. Remember, the iPhone came in and the smartphone industry started in like 2006. So a lot has changed, but at the same time, the markets tend to kind of follow patterns. So we also see that even though the markets are near highs, the average stock is not near a high. It's just those stocks in the indexes that are moving the market indexes to new highs. So right now, we only see about half of the stocks are in positive trends, and about half are not. So we usually don't top out in the market when we're about half stocks are not in positive trends or negative trends. Usually we have a market high when 80 to 90% of the stocks are nearing their high. And we're not anywhere near that now, even though the market is at a new high based on the indexes. So when you look under the hood, Chris, there's a lot of really weird things to think about.
Well, yeah, and we could actually see, if you could see coming into 2022, indexes that are down when the majority of investors are up, right? Because if you have these top 5, 10 names that are maybe pulling back, well, the rest of the market could be doing just fine because, like you said, Brian, it trailed or, was up average returns, in 2021 and wasn't up 100%. So, we could see almost a reversal kind of from last year's market this year where the average investor, did pretty well, but the indexes were actually, average to down.
Well, and also just by way of reminder, for those who are around, in the 1995 to 1999 period, there became a general opinion that most diversified managers could not beat indexes. And that was because the indexes are so heavily weighted toward those names. Well, that's kind of the same thing that went on last year, not so much in 2020, but in 2021, it's very hard for a diversified manager who buys stocks in equal proportions to outperform a benchmark. But then for the 5 years after that, during the crash period and then the recovery from that technology crash, then it was much easier for a diversified portfolio and therefore a manager to beat benchmarks because the large names were crashing. So if we got into a period of time where those individual names, like you said, Chris, start selling off hard, but the average stock is doing better than that, then an investor could easily beat a benchmark. And then you'll have a period of time where 70% of diversified accounts are beating benchmarks instead of only 10 or 20% like last year.
Exactly right. Yep.
So anyway, so if we were to place new money in the markets, we probably wouldn't put 50% of it in one sector in the market. So that's why it's going to be hard for an individual to beat benchmarks. Now, if you want to perform every year and you have to get performance and beat benchmarks every year, then you scramble and figure that out. But if you have a longer term plan, you don't really play all those risky games and you wait until the markets come back in your direction. As long as you get the returns that you need, and that's built into your plan, then you don't have to worry, gee, I didn't beat the market this year. And, just for the record, many of the 4-star portfolios did beat the markets big time in the previous year. And it was because we had our protection program to avoid the big loss that happened during the pandemic. So, if you slow and steady wins the race, if you will, and if you can make sure that you have a portfolio that's well diversified, in some years you have really great years, and some years you have lesser years, but nonetheless, you'll meet your objectives, which is really what it is. Trying to scramble and beat benchmarks every year sometimes is a really, really a risky game. So.
Yep. Well, and I think it just shows that there's this connotation that, all right, well, if I just buy the index, I'm diversified. And just as we spoke about, doesn't necessarily mean, I think, is there a strategy behind that? You could, but I think that's why it's important to, talk with financial professionals that have, knowledge about this, because, people that own just SPY or the S&P, they might be happy last year, but, they could be in for a shock this year, so it's important where, to have that diversification and, like you said, focus on the long term.
Yes. Well, and then one more metric just to point out about how weird the market ended up being last year is normally in a market where we're hitting new highs, the list of stocks that are hitting new highs, I call it the new high list, grows every week. And in the last 6 months of last year, the new high list was not growing, but the new low list, ironically, was growing. So we're seeing indexes hitting new highs, but the average stock not doing that well, the average investor not doing as well. So it's one of those years where you really need to, open up the hood and look on what's going on in the market to understand what's happening. So let's pivot now, Chris, to this year. Today's the 7th of January, 2022. Welcome to 2022, everybody. And as we start out the year, we had a couple days of rally and then a really, really bad day with technology, and that's continued a little bit today. And now what's working, of course, is the commodity related names, oil and gas and things like that, that did very, very well last year. So what else do you see out there, Chris?
Yeah, I think what we're seeing, like you said, Brian, is the increased volatility will have come into 2022 as kind of the themes towards the end of 2021, I think are going to kind of come to the forefront, and that being A, inflation, and B, what the Federal Reserve is going to do if they raise rates. When are they going to raise rates? I think that's why we're seeing, some of the tech stocks sell off, because, as those rates go a little bit higher, it's going to put pressure on the market to get better returns.
Yes.
So, it'll be interesting to see kind of with 2022, what's gonna happen. I think from an asset allocation perspective, coming into here, in 2021, the biggest winner by far was commodities. And I would say the biggest loser was international equities relative. And, coming into this and kind of over the last month, if you will, we still see domestic equities as the #1 and commodities as that #2 position. And that really hasn't changed since commodities took over about mid-2021. But international equities in the third position continues to deteriorate. It's at lost 5 points from the last podcast, and it's still in the third position. Still has a way to go, but still continues to slowly deteriorate. And then in the 4, 5, 6 positions, the bottom three, we have fixed income. It's stayed steadily in the same position, same point tallies. It's moved up slightly. I think it gained about 4 points in the last month. Cash in fifth gained about 4 points in the last month, and then currencies continues to kind of stay flat, if not deteriorate a little bit. It's at 56 and lost 1 point. So, it'll be interesting. We had commodities had a major leap last year. It'll be interesting to see if it continues. Usually you see it probably continue with inflation would be the expectation there. If inflation continues to be high, and it'll be interesting to see if we see international equities bounce back and kind of challenge commodities in that number 2 position, or if it continues to kind of stagnate the third position.
Yes. Well, the American economy is still strong, although it's been a little weaker than people would like because of the continuing issues of the pandemic. And, Chris, just reviewing the Christmas sales numbers, we in 2021, Christmas sales were up 8%, which is nice. But if you look at the inflation, which was up 6.8%, we really only had a real growth of sales in Christmas about 1%. So it wasn't actually as good a Christmas as folks would like. The 2020 Christmas sales were up 12%, but with very low inflation in 2020. So the real growth of Christmas sales in the previous year was over 10%. So it turns out the Christmas selling season wasn't that great. We still enter into a growth economy, Chris, but not as strong as it had been. And so the markets could react to that. We'll talk about what the possibilities are there. Now, Chris, you looked at some of the other metrics, ISM, confidence board, things like that.
Yep. Yeah. So a couple of other statistics that came out. ISM index, the national factory activity levels, it fell to 58.7 in December. Anything above 50 is still expansion, so it's still expanding, but it dropped from 61.1 in November. So a slight pullback there. The expectation was 60, but still overall a positive number. The Conference Board as well, that's a private research group. Their consumer confidence index came out at 115.8 in December. That was up from a 111.9 in November. Interesting, some of the things they noted is they actually saw a decline in concerns about COVID-19 and inflation, relative to previous concerns. And I think some of this is just going to come as people learn to live with COVID-19. As I know we're going through kind of the Omicron variant now, but it seems to be significantly less mild from a hospitalization standard and everything there. So I think some of those concerns have slightly pulled back, which is why that got boosted up. And then, the last thing I'll mention, the housing market is something we talked a lot about in 2021. And some of the statistics that came out are really crazy. So the S&P CoreLogic Case-Shiller National Home Price Index, so the average national price of a home, rose to 19.1% year over year in October. And that was actually down from September. The September reading was 19.7, but still extremely high. We're still clipping almost at 20%. Existing home sales rose almost 2% in November, 1.9 month to month. So we're still seeing that continue. And that's a third straight month that we did see a rise in existing home sales. And then as we've spoken about this before, the median existing home sales price. So the average price of a home rose almost 14% year over year in November, and it's now at $353,900. So very high median home price across the nation. And one thing is that this high medium home price is really doing is it's pushing a lot of the home buyers out of the market. First-time home buyers only accounted for 26% of home purchases in 2021. That's the lowest level since January 2014, and it's down 32%. So down 32% total from November of 2020. So we saw a massive, almost a third drop off in first-time home buyers as we continue to have home prices continue to move upwards. And then once again, a good measurement of this home price is mortgage lenders. They issued 1.61 trillion in purchase loans in 2021, and that's a new record. It was up from 2020 numbers of 1.48 trillion, and it broke the previous record of 1.51 trillion, which was actually set back in 2005. The housing market continues to be very hot. There has been signs of it slowing a little bit, but once again, I mean, slowing a little bit in a very hot market doesn't really mean a whole lot. It means, going from very hot to hot, if you will. So I think some of the challenges it could face coming into 2022, if the Fed does start to raise rates, we could see that start to tighten it a little bit more. But coming into 2022, it's still a very hot market.
Yes. Well, it's interesting. It's a national market, but as we all know, real estate's a local market. So every market functions a little differently. And what Chris quoted were the averages nationally, but it isn't really a national market. All real estate is local. And so they continually do surveys on movement between states. And the high tax states and the slow growth states have been losing out to the low tax states and the high growth states. So the survey showed again that U-Hauls and trucks and all those, they can tell by where those items are rented and where they end up arriving. The states that people are moving to are Vermont, Florida, Arizona, North Carolina, and Texas. And of course, the states they're leaving are our home state here, Illinois, New York, California, Connecticut, and Jersey are the top 5 states that people are leaving. So, and in those markets, the real estate prices haven't been as strong on average. They were below the average growth. And in the 5 states where people are moving, those numbers are higher than the average, of course.
Yep. Yeah, I mean, you definitely have probably the middle, right? Like any average, you have the states that are kind of averaging it, and you have some states that are losing on the lower end. And I know Tampa is another one market. We were talking to one of our clients, actually, they moved there, and the appreciation of the real estate values there, it's almost 40% year over year, and then 40% again the next year. So I mean, we're seeing massive appreciation in certain markets, and average, if not below average, in other markets.
Last year, oil prices were spiking as investors in oil securities and oil partnerships did really well. And ironically, the Omicron and all the different variants had little impact on demand. West Texas Intermediate crude recently was $77 a barrel. There are some looking for $100 a barrel again. The high price was in 2008, $144 a barrel. So who knows if we'll get up there. And then the iShares ESG portfolio was up 30%, but the energies were up high 30s, low 40s. So we're still seeing energy being a strong part. And that was part of the S&P 500 that really wasn't part of the NASDAQ and some of the other indexes. So that's why the S&P did a little bit better. But it wasn't because of technology, it was because of energy and commodity related things. And non-ferrous metals, lithium, real estate, all different kind of hard assets did well. So people often, I remember when I got in the industry in the 1980s, people would ask, what's your best investment? And they would just gone through a high inflation 1970s, and everyone raised their hand and said, my home is the best investment I've ever made, because we just went through a bad stock market period, and the market had finally bottomed in 1982, but it had been about a bad decade in the stock market. So now we're seeing that as well, with inflation causing real estate prices and commodity related things to go up. But the real estate markets collapsed in 2005 to 2012. So even though we're having a really, really big move in the real estate market, don't forget, we just went through one of the worst real estate markets. And in fact, the worst real estate market in American history. Was worse top to bottom than the Depression in the 1930s. So real estate markets have been hot. But they do go through rough periods, and everyone probably remembers someone that lost their home in 2010 or 2009 because they were over levered and the real estate prices collapsed. So there is a downside to real estate prices too, and just like any market, so we have to be really careful. But Chris, last year inflation is what was up 6.8%, right?
Yep. Yeah, I think towards the end it was clipping at 6.8%. And, I think it's a good point with real estate. I think, there are a lot of positive factors that are, with the current real estate market, mostly being supply and demand, which we've talked about at length on here. You have a lot of people that want to get more space and want to move to, houses, maybe the suburbs, and just get a little bit more space in that. And, you have the supply, which has just been, which we found out this year, really under really what the demand is. And I think a lot of it was you had the expectation, you rewind back 3 or 4 years, that millennials weren't going to go to the suburban markets, that the millennials were going to stay in the cities. And you had that trend start to happen just before COVID. And then COVID is essentially opening up a dam, and all that flood, where all those millennials just flooded towards the suburban market. And so you really had this almost rush. And, we still have a ways to go before we have, I would say, an equalization of supply and demand. So we'll probably see prices continue to appreciate. There's a lot of factors that could impact it. One being, interest rates certainly are going to play their part. But, at some point it will equalize. And at that point, we'll probably start to see it slow down and possibly, decline, like you said, Brian.
Right. So when we look at inflation, with the average inflation up 6.8%, but certain commodities are up even more. Bacon, our favorite, of course, is up 21% for the year. But even all the main meat lines are up. Beef is up 13%, eggs up 8%, apples up 8%. So all commodities and foodstuffs are going up. And sometimes they quote these inflation indexes less food and energy. But then when you include food and energy, last year inflation was up big, obviously. But we consume energy and we consume food. So I think you really have to leave them in there because they're really part of our basket of goods, which is what the government calculates the consumer price index on, is the standard basket of goods that the average American buys. So, but inflation is really, really rough. And inflation is really hurting consumer pricing. We saw the consumer spending numbers at Christmas, obviously, are an issue. So we'll see what things materialize to be this year. I know that many of the spending programs that were passed during the pandemic while President Trump was still in office, and then the recent spending programs under President Biden, some of the money, in fact, a good chunk of the money that was authorized didn't get released last year or the year before. It's getting released this year and next year. So if all that money out there is still chasing goods and there's no new production of goods or no big inventory build, we're going to probably see inflation continue for a period of time, Chris. That's what it looks like right now.
Yeah, I mean, I think, from some of the things I've seen, I think on average, like supermarket or grocery store goods are going to probably be on average of between 10 and 20%, depending on the good. We'll see rate, rise. So definitely going to have a little bit more of an impact. I think the consumer is going to feel it a little bit more, the inflation in 2022. With that being said, we're also seeing, tight labor markets. We're seeing with that, rates rise, salaries rise overall. So, we could be in kind of this dance for a little bit. And I think the supply chain shortages are important. I think it's starting to unwind a little bit. But, you have a lot of money being thrown around right now. And even on top of that, you could add legislation in certain areas isn't helping. I know in California, they just passed a law that went into effect in 2022 where pork farmers, which, that provide the bacon essentially, the pens that the pigs have to be in have to be a certain size. They have to have a certain amount of space, which is going to impact the amount of supply they can provide. If you have a farm with X amount of land, if you could fit 100, pigs on that farm, and now you can only fit 50, well, it's gonna cut the amount of bacon you can produce in half. So, with supply and demand, if supply goes down, demand stays the same, we'll see the prices go up. So there's a lot of factors impacting inflation. And I don't think it's going to go anywhere, at least in the short term.
Yes. So those are the things that we see out there right now in the economy. Now, the question we turn to is the markets. What will the markets do based on the economy? So the economy is still strong, but slowing a little bit. We just saw another jobs number where they were expecting 455,000 new jobs, and it came through at less than half that. So that could be affected by this recent Omicron variant. The Delta variant is still out there. There was a record number of people leaving their jobs in November. That also had to do with most likely with COVID. But then again, the issue really is, okay, if the economy is a little slower, what does the market focus on? Because the market could go up when the economy is weak. We've seen that happen before. So earnings are still strong, and companies have passed on those price increases that inflation has caused. And we managed to get through the fourth quarter with okay numbers, but Christmas was weaker based on inflation adjusted. So the question is, will the pace of growth in the economy continue? Will it accelerate? Will consumers continue to buy goods at the same pace, or will prices slow? Normally, in the beginning of a growth phase, rising interest rates are good and rising prices as well. It's just that it was such a shock to the system and not a gradual growth of pricing. So it was a quick spike up in inflation. So it may have a little bit of a shock to the system and cause fundamentals not to be as strong. But if the fundamentals remain strong or they get a little stronger, then the market could say, gee, we're going to buy stocks, we're going to go higher because the fundamentals are strong. But if the fundamentals were weak, we could still look to the asset flow numbers. So like I mentioned, there's significant amounts of spending that's coming out of the federal government and local state governments over the next couple of years based on all the bills that have passed. We spent between the Trump administration and Biden administration, we've authorized about $7 trillion in new spending, which is by far record levels. And then the Fed has put a similar number of trillions of dollars into the banks. So all that money is going to flow out and go into some good, and we'll probably see inflation. And that could also mean inflation, Chris, for the stock market and stock prices. So, if the market ignores the economy and reacts to asset flow issues, we could still see a rising stock market and rising commodity markets, even though the economy isn't that strong. And again, once again, it's what will the market focus on? The market could focus on fundamentals, and they're either good or bad. Market goes up or down, or it could focus on asset flows and money flows, and those probably will be positive over the next year. And that could put a wind under the wings, if you will, of the stock market. What do you think, Chris?
Yeah, I mean, I think certainly. I think you're going to see some asset flows with this inflation number from the fixed income market. Because if you think about it, if you have a bond that is yielding 3% and inflation is 6%, let's just call it, your real return is negative 3%. You're losing 3% this year. So with the high inflation numbers, most investors will have to put their money, or at least a good portion of it, into the stock market to get a return on their money that they're looking to to save and to grow. So that is definitely going to help. It's going to put some wings underneath the stock market, at least in the short and near term. And I think overall, what we're going to focus on this year is definitely going to be inflation. It's going to be policies. Like you said, Brian, there's a lot of money that has been thrown around the last year to 2 years. And there's the potential for a lot more money. So kind of what direction those policies have going. We could see a lot more money come out if those pass, and likewise on the flip side if they don't. So I think that's something to keep a close eye on. And then I think the Federal Reserve, that's kind of the other big one to touch on is, if they decide to raise rates, it's definitely going to have some impact on the market. It doesn't mean the market's going to collapse or pull back on it, but it's definitely going to have an impact.
Yes, and the Fed is always tinkering with the economy. So now they're saying they're going to raise rates, and they're being a little more aggressive about their view of raising rates. And so then we had a bad day in the market last week because they announced that they were going to raise rates a little quicker. And, but rising rates at the beginning of a growth economy is not necessarily negative. It's a demand for money. It's a good thing. It's just when rates get really, really high, we're clearly nowhere near that. We're at record bottom, low bottom interest rates. So, but, the Fed will keep tinkering. So there's been a whole body of discussion about what does the Fed put? Like, at what point does the Fed say, okay, the market's down, we got to, lower interest rates to get money going, If the things heat up too much, we're going to raise interest rates. So that the Fed is always tinkering around, and they know what levels to go with. But if we did have a recession, recessions don't happen when the Fed tools work, because the Fed will do whatever they can do to keep the economy going. But usually what happens, like in 2008 and 2009, the technology crash, the 1970s oil market, the depression, and all the other bad economies, they usually happen when the tools the Federal Reserve has really are unable to really cause any growth anymore. So in 2008, 2009, we had a housing crash, and the markets crashed and the housing crashed, and the Fed lowered interest rates to zero, but it didn't do any good because it was going to be a bad economy, and the Fed's tools didn't work anymore. So as long as the Fed's tools work, then we'll continue to have a growth economy. But when it gets to a point that things melt down, well, then the economy is going to recess, go into recession or depression. Hopefully not. But then eventually it'll work itself out and the economy will go back up. So the Fed's out there always tinkering, and hopefully the Fed is able to manage this so we don't have a big economic downturn.
Yep.
So Chris, when the What We See Out There segment, we talked about, some interesting changes under the hood and in the economy. And I hear that Tesla is doing really, really well now. But Toyota is now, again, the largest car seller in the world. Is that right?
So Tesla, Tesla got a huge boost coming in 2022. Their deliveries in 2021 roughly doubled their 2020 numbers. They almost delivered million cars, so 936,000. Whereas in 2020 they delivered about 500,000. So blew away analyst expectations, and that's very positive for them. They got a huge jump with some of the volatility and over the last couple of days. It's pulled back a little bit, but overall their stock bounced back above 1,000 per share. And then, like you said, Brian, Toyota on the other front, for the first time, I think almost ever. I mean, it goes back to 1931. For the first time since 1931, Toyota actually outsold General Motors in the United States. So for the first time, more Toyota cars were sold in the United States than General Motor cars, and this leads all the way back to 1931. So we're seeing Toyota, continue to gain shares as well. But I think all the cars manufacturers have definitely gotten a bit of a boost. I think Ford was up another 12 or I think it was about 20%, I think, to start this year. So it's going to be interesting. I think Tesla got out to this massive jump to kind of kick off this electric vehicle, movement. And now we're seeing a lot of the other cars really start to catch up. A lot of people are excited about some of the new innovations in cars they're rolling out with. It's going to be an interesting couple of years, I think, in the car market, which for the last decade, outside of Tesla, if you go to the basics, GM, Ford, have been pretty bland. So, those other car companies might start to get a little bit more exciting, if you will, as they go deeper and deeper into the electric vehicle market.
Yes. Well, and moving on to parts of the economy, and talking about what we see out there, let's call him Tinkerbell Joe Manchin, the senator from West Virginia, gave the Americans, we think, a big, huge Christmas gift, because most economists are now considering that much of the excessive spending of our federal government is actually now starting to hurt the economy with inflation. It's actually hurting job growth. So you wouldn't think that, right? When you give people money, things should be better. But in a sense, that's most economists think that massive spending is now overspending, causing a lot of problems. There's a record inflation year. They got rid of some of the spending programs in September, but we understand that some of them are still going, even though they've not been authorized anymore. So, in a sense, Joe Manchin saved the economy from recessing even further and going into a recession, because all that extra spending could have caused more problems. And 70% of voters say 2021 was a bad year. And most investors, makes you wonder what the other 30% are thinking, because, it was a bad year. The economy was okay. It was still growing and the stock market was up. But a lot of registered voters feel it was a bad year because of all the debt and all the rancor that went on. 55% of Americans think it's been a bad year for their families. And as judged by the public's reaction, our current president, Joe Biden, is the worst underwater of any president in American history. So they measure constantly favorable and unfavorable ratings. So Joe Biden currently has a 40% favorable and 60% unfavorable. That's a 20-point gap of underwater. And that's the largest gap we've ever seen in American history. And President Biden's poll numbers continue to weaken. And I think it's a reflection of some of the policies of spending in the border and things like that that have really rankled a lot of investors. So, you know, we all want our president to do well. We want him to turn it around. I think some of the policies are causing them problems themselves. You know, they talk about following the science, yet they're not following it really, and a lot of other issues. So there's a real cancel culture and people are frustrated with the administration. So hopefully it turn it around and they get things moving back in the right direction if that's their inclination. Americans are generally considered to be the leading people in the world and well regarded, although I think because of all the rancor in the last year, I think Americans are less trusted by the world than we were a year ago. So we need to kind of turn that around. Although on the other hand though, Chris, China is starting to show signs of weakness as the real estate markets are collapsing in China. You know, they also did some things regarding, you know, handling IPOs. Company came public and then within a week it got shut down by its own government. And so the stock went down 70% and they had to refund all the money to the investors. And one company, JD.com, was down huge as the Chinese government forced them to distribute shares that were all sold, and they broke all the rules just because the government decided that they wanted to do this for that company. So, you know, I always say, why would anyone invest in China? Because you can't really trust the rules. There's no rules that are set. They're going to do whatever they want to do, Chris. I mean, I can't believe it.
Well, yeah, I mean, you've definitely seen in 2021, and even I would say the tail end of 2020, you've seen the Chinese government start to really tighten their grip, I would say, on the market, and especially certain areas of the market that they deem, you know, essential or have gotten kind of overvalued and gotten too rich. So we've seen that, and you know, I think a lot of companies are kind of taking a good hard look at China. I think it still is kind of this, you know, enticing apple, if you will, because, you know, very large population there, and there is a lot of revenue to be made there. But, you know, like you said, Brian, you know, if the you know, Chinese Communist Party continues to change the rules on the fly, crack down, and cause issues, I think companies are going to start thinking twice before endeavoring into that market. You know, and I think even on top of that, you know, I think a lot of people, you know, last year and even coming into this year, we've had a lot of geopolitical tensions out of China, out of Russia. You know, you have Ukraine. So there's a lot of things going on around the world that I think, you know, causes people to kind of take a step back, if you will.
Yeah. Well, and you know, the American capitalistic system, which is democratic, where folks have the right to make individual decisions, that capitalistic system has caused America to become the wealthiest nation in the world, created more prosperity in world history than any other system, capitalism with certain proper regulation and that kind of thing. So all governments want the benefits of capitalism, yet the base level principles that cause capitalism to flourish, like freedom, like the ability to make individual decisions, each individual actor in the economic system deciding what they're going to buy and sell, not being told they have to buy something, not being told they have to take a vaccine, not being told that they have to do certain things. So that's what leads to success in capitalism. It's when governments try to control the economy and they put their hand on capitalism, well, then it doesn't work that well. Anyone who was around in the 1980s when Japan was levering up their economy and controlling it very much so by allowing more leverage, they were buying up assets all over the world, all over America. Everyone thought the Japanese were going to take over the world, but that whole system came crumbling down. And they're still in a recession in Japan because they tried to control capitalism in a way that really didn't allow it to flourish. So now we're seeing some of the same things in China and other countries. We've seen this in in Eastern Europe. We've seen this in Russia, where these governments, they want the benefits of capitalism, but they want it to be convenient for them, and they control it. And then, of course, it all breaks down. So a lot of traders are investing in China, and they can make big money. But those are the folks that can go flat in a heartbeat. Like if they need to sell other positions, boom, they're out. It's the investors who go long-term in China are the most at risk. So we would kind of caution investors to taking too seriously to an economy that could easily blow up in their face at any time. Political unrest and the will to control everything. And we do a little bit of that here in America as well. And to the extent that we cause controls on our economy, then that hurts capitalism. So we want to make sure that we don't overdo it. We don't over control our economy. Let capitalism flourish. Let people build their net worth and let prosperity reign in America. And the extent that we do that, we'll continue to have a great economy. And of course, the COVID and all our reactions to the COVID have caused some issues. We're doing a little bit of that again with the Omicron variant, and people, some governments tending to overreact to some of those issues when the Omicron is really just a common cold. So hopefully we don't do too much of that, and we continue to let capitalism reign. And let's hope, Chris, that we have another great year in 2022, and we continue to be the leading economy in the world.
Yeah. I mean, hopefully, 2022, continues to be great. Hopefully, we see. It seems like we had the COVID kind of seemed to wane a little bit in 2021, and I think hopefully we continue to see, it wane as immunity and all that kind of gains. So hopefully we see it in some cases a renormalization in 2022. Hopefully, so we'll see what the year brings though.
So here's hoping we have a great year, 2022, everybody. Welcome to the new year. Hopefully this COVID is mostly behind us. We can go back to more of a normal life in 2022, and we're looking for a great year. So we wish everybody a happy new year. Welcome to 2022. We'll be back with a lot of interviews of various players in the economic system. We did an interview that'll be out very soon with the cannabis lawyers that we met in the spring of last year. A lot of interesting developments in the cannabis markets. We have a whole series of other interviews as well coming. So we're excited about the year. And please let us know, folks, if there's anything that we at 4-Star can do for you and your family. Let's make it a great year, everybody. Maybe we leave it there, Chris. What do you say?
Yep, sounds good.
All right. Thanks, everybody. Let's make it a great year. Bye-bye now.